I made a lot of mistakes, and now all of my clients get to benefit from the fact that I made a lot of mistakes, and that's the best way to learn, isn't it?
Can you define what turnkey investing is?
Because markets go in cycles, and what is a good market today from an investor perspective may not be a good market tomorrow.
First off, you can buy property for $60,000.
You can.
So would you ever buy a property that doesn't cash flow?
No.
Like if I came to you with $3 million, could you handle that?
Oh, I could handle that.
How can you flip a property with interest rates like today? How can you find a rental property that cash flows with interest rates like today? What's your answer to that? Hello and welcome to the Real Estate Doctors Podcast, where we're here to educate, inspire, and entertain you. Today, I have a super special guest. His name is Phil Alexander, and he's the CEO of Portfolio Properties USA. I think it goes by PPU. He is an expert in turnkey rentals and the BRRRR method, which we'll get into. He has been in 17 markets. He has invested and counseled people in 17 markets, over 2,000 transactions done, and he has coached and mentored over 5,000 people in the real estate space. So I want to say, as I always do, we record these podcasts, outdoors, sometimes indoors, but I really like to show the beauty of Aruba. Today, I have a very special place, which is my home. So welcome to my home. This is a very sacred place for me, my backyard. And for those of you snowbirds or people like me that are from the Northeast, I will tell you, there is nothing like, I spend probably 40-50% of my time in this space. And it really, that whole vitamin D, I think it is from the sun. And man, we just feel happier down here. So if you can, listen to what we're going to teach you on the podcast, and you can make your way to living in the Caribbean. So, without further ado, Phil, thank you for joining me on the podcast. Thank you for being a guest at my house.
Thanks for having me. It's a true pleasure to be here. I'm born and bred in Boston, and I don't want to kid you. I left Boston earlier this week. It was 32 degrees Fahrenheit, and I think it was somewhere around 85 when I landed.
Yeah, it's a big difference.
It's a huge difference, but it's a great vibe here. It's no mystery why you have decided to just plant your stake here and enjoy Aruba.
Okay, all right. So Phil, I just have some questions initially with some of the intro. Can you define what turnkey investing is?
Sure. It's really changed a little bit over the years, but basically turnkey investing is where an investor will buy a property, typically that's been renovated, tenant in place, and you're cash flowing from day one after you close on it.
So I guess that's where they get the turnkey.
Exactly.
You turn the key.
Exactly.
And, so what is the what's the alternative? Maybe some people only never called it turnkey, but they're like, okay, well, if I'm going to buy a rental property, I would buy it finished and tenanted.
I think the problem here is actually taking a step backwards. Psychologically, there are a few things we know about investors, one of which is they're always more comfortable when they're a newbie, when they're just getting started, to invest in their backyard. The problem is that, there aren't great markets, to always invest in. If you live, say, in California or New York or Boston or Washington, these are not good cash flowing markets. They're great places to live, maybe, but not from an investor perspective. And so the reason why I've worked in 17 different markets is not because I'm fickle, not because I wanted to, brag or show off that I've worked all over the place. It's because markets go in cycles. And, what is a good market today from an investor perspective may not be a good market tomorrow. Without even getting into what makes a good market or not, when you see the prices changing, I always say that there's a seesaw relationship between home prices and annual returns. If you're in a place where the home prices are high, the annual returns are low. So what we seek to do in the business is go where they flip the script and the prices are lower and the returns therefore are higher. And what we try to do is encourage investors to focus on these markets, to realize, for example, that it is very safe, secure to invest out of state if that be the case. There's professional property management that you'll have to take care of your property, and as such, it's a very safe thing to do. I mean, the last comment I often bring up when people are struggling with that idea of investing out of state is, if you were to go and buy stocks in, say, Microsoft or Facebook, would you move to Redmond, Washington or Menlo Park, California before you bought those stocks? Of course not. And, let's face it, rental real estate is an asset class no different than Wall Street. It's just better than Wall Street.
Okay. So I have let me start with this. So when you hear seesaw relationship, and let me just go back a little bit, and Phil and I have known each other for probably about 10 years. And, I know that Phil has been selling, he does transform with the times, which, I don't know if I'm following your lead or, you have to, because certain markets get too expensive and they don't make sense anymore. That's when you sell. Hopefully you got in that market in the beginning and now you're selling later. So I remember, you were in markets, 10 years ago that you're totally not in anymore, and now you're in markets that you were not even thinking about 10 years ago. But when you hear seesaw and, hey, you buy, property prices lower, you get a higher return, some people might hear, well, hold on, you're telling me to invest in the hood, right?
No, yeah, yes, that's maybe how some people interpret it.
Let me, for my international people, oh, by the way, I'm in Aruba, which is a Dutch island. It's in the Kingdom of the Netherlands, and I'm wearing this color, orange, for the House of Orange from the Netherlands. So, big props out to the Netherlands. So anyway, so the hood is, not as nice neighborhoods, the least neighbors. So instead of buying in the nicest part of town, you're buying in the worst part of town. And what naturally I would even think, if I didn't have experience, is I would think, well, the numbers are going to look good, but who says they're going to pay me rent? So how would you address? Did I hear that wrong?
Well, it's an assumption that a lot of people will make. I've worked in some markets where as soon as you say the market, people say, oh my gosh, there's all sorts of crime. Like Baltimore. Baltimore is a fantastic market to invest in, but immediately people might bring up one of my favorite streaming series, The Wire. Yeah, you can find those sketchy, difficult neighborhoods if you really seek them out. But that's not Baltimore. That's not what Baltimore is all about. It has so many other reasons why it's a good market to invest in. But a lot of people have borrowed from commercial real estate the A, B, C, D classification of properties or neighborhoods. And, it's a little arbitrary. Not everyone agrees precisely, but an A-class neighborhood is, let's face it, a neighborhood where you or I might enjoy, living. It's almost exclusively owner-occupied, high prices, low returns, because, again, there's that relationship. The B neighborhoods I define as 50% or more are owner-occupied, but there are some tenancies, and the prices are a little lower than the A neighborhood, but the returns are a little higher than the A neighborhoods. Then there's the C neighborhoods. Now, the script is flipped. It's 50% or more tenant-occupied. Prices are a little lower still. Returns are higher. It is, in fact, the investor sweet spot in almost any market because It has the most mobility and room to go up. But for now, the prices are right and the returns are solid. Well, the D neighborhoods, as you were talking about the hood, that's where I lock the car doors as I'm driving through, you know.
Okay. So you're not in the worst part of
We
town.
are not in the hood. And we actually, within the context of the so-called C neighborhoods, we also are looking at the area around it. And we're focused generally on that part of the C neighborhood, which is most close in proximity to a B or even a developing A.
Yeah, I mean, I don't know if it's luck, but I've bought a lot of C's next to A's, and before I know it, I'm the ugliest house in the A neighborhood, and people want to buy me and tell me to leave. So I'm always happy with that. Okay, so it sounds like you're pretty strategic in how you evaluate a market. So how do you determine this is a great question for a lot of people. Like, okay, so I'm from California. How do I know if I want to invest in Oklahoma City, Chicago, Columbus, Ohio? Like, how do you analyze a market? How do you find a sweet spot that works for you?
You look at a number of different factors, and anybody, a newbie or an experienced investor, has this information at their fingertips. We look at a market for population growth, job growth, or more to the point, the unemployment stats, vacancy rates, which you can check out via the real estate website for that particular region or city. We look at rent to price ratios, and something that I don't consider an absolute metric, but it's an important metric, and that's we call it the 1% rule. That is, just simply put, if you have a property, I'll just pick a figure that's $100,000, you want the rent for that property to be $1,000 or more. If it's dramatically under that, then your return is going to be at a shortfall. If it's way over that, that can be an impressive opportunity. And so we look at these things, but we also will, if we're on our game, and we'd like to think we are, we go back and look historically. We'll go back 15 years, right before the crash, if you will, of 2008. And we'll look at where the home prices were at that time. Then, of course, everything dipped nationwide, and then came back up. Now, a lot of markets, virtually all markets, have reached or now exceed that pre-recession high. But still, it's the ones that are still trending upward. We know historically that is going to continue. It might slow, but it won't typically drop, because a lot of what was behind that crash in 2008 has now been corrected in terms of, predatory lending and that sort of thing, which caused the crash in the first place.
Okay. So let me define here. So I started asking about turnkey rentals, and we got into like what is called out-of-state investing. So what's your thought? What does out-of-state investing mean to you? And if I'm living in California, I'm like, okay, that sounds great, but how am I going to check the house? What if something happens? It's so far away. How can I trust anybody? So can you define for me what out-of-state investing means, and how do I get over those concerns that I would have? Because the numbers obviously, I would imagine the numbers are way higher to invest out of state. We're using California as an example, but I would have a lot of concerns if I lived in California.
Sure, as well you should, but it's also the reason our strongest and largest client base is in California. As I said before, California, New York, Boston, Washington, D.C., these are places where you cannot cash flow positively to save your life. You can always find, I think you would probably agree, anywhere in the country, you're going to be able to find a deal that makes sense for you. But at scale, as a business, no. And so out-of-state investing is all about, I think, finding the right team or partner. I advocate, obviously, the right team because we are here with a fully constituted team. You know, we know the markets that we're in because we've done that strategic research to know whether it's an investor advantaged market or not. We know the neighborhoods intimately. We have our own crews to renovate, which is important on a number of different levels. But managing, if you've never managed a contractor, good luck. It's not easy. Finding a good, reliable contractor, managing them, from a distance, not easy. We take that concern out of people's minds. So when you work with a company such as mine, you're using 20 years worth of experience. And we are in the markets we're in for a very clear and specific reason. And that is because it makes sense for investors. I'm an investor myself. You're an investor,
Sure.
But I'm about, 800 years old compared to you. I bought my first.
I'm feeling young now.
I bought my first rental property. I know, you look at me and you think, he's got to be, maybe 35?
Yeah.
36.
Let's go.
I bought my first rental property, I think, in the year you were born, 1978.
Yes, that was. Why you got to give my age out like that?
I didn't say that. You didn't have to agree.
Yeah.
But anyway,
Okay.
but no, I have been investing for a number of years, okay? And as such, I made a lot of mistakes. And now all of my clients get to benefit from the fact that I made a lot of mistakes, and that's the best way to learn, isn't it?
Well, for me, you don't forget a mistake that you make. Like, it's one thing to read it in a textbook or hear about it on a seminar or on TikTok, but when you do it, it sticks. So, all right, there's one question you didn't, so you were talking about a team, and, property manager was not part of that team. Did you exclude that for a reason?
Well, I don't sell property management, but that said, I have property managers that I consider preferred property managers. The reality is when you buy a rental property or a turnkey property in let's call it a foreign or out-of-state market, once you close on that property, you are driving the bus. You get to decide if you like the property manager that may or may not already be in place managing that property. It's up to you. We counsel and guide our clients when buying properties. Here are a set of questions. These are great questions to ask a property manager, plus anything else that might occur to you. These are the important things that should be important to you.
Okay. First off, so if I were to, first off, what do you sell? Because you said, I don't sell property management, and I don't want to make this like a sales thing, but I don't think it's clear. So this is what I hear. Tell me if I'm incorrect. You offer some type of mentoring or consulting for out of state, for people in states that it doesn't make sense for them to invest in those states. So you might say, let's say you like Knoxville, Tennessee. You will say, yes, I can help you in Knoxville, Tennessee. I have a team there. I have hookups for deals. I have contractors. And I would imagine, you don't just go here, figure out your property manager. You have some, if you're in that market,
correct.
You might have some that you already know are good. Is that?
All correct. All correct. We offer, though, a couple of different ways that you can invest in real estate. Turnkey was the age-old model, where an investor would go to a seller or a developer, maybe like us, and I'd show them a number of properties that hadn't been renovated. They'd say, okay, I like that one. They'd put it under contract.
That wasn't renovated?
Was not renovated.
Okay.
And yet they'd say, I like that one, but in offering it to them, I would say, okay, here is the price. That includes the renovation. And they'd say, okay, boom. They'd put it under contract. It would take, anywhere from 1 to 3 months, depending on the amount of renovation or rehab needed. We'd renovate it. Then the buyer would have a third-party independent inspection done. inspection reports in this business, even on a renovated property, are always a four-letter word: ugly. And, as such, we say, okay, send it over to us. We're going to correct anything of significance or safety-related items. You can even have it re-inspected by the same inspector if you want afterwards, but we're going to correct all that at our expense. Then if they're using financing, they'd have their lender come out and appraise the property. Presuming it appraises correctly, a qualified tenant would be put into place. Then and only then, after the renovation, inspection, correction, appraisal, tenanting in place, then and only then would you close, and you'd be cash flowing from day one. Now, there's a problem with that model, though. The problem is, yes, it's passive income, and that's always an important thing, but because that's really the only way to truly create wealth and to build wealth is passive income. However, you need a lot of capital if you're going to keep going. Because once you've invested what you have to invest, whether you've leveraged or not, you need to wait until you get another, whatever, $25,000, $30,000, $50,000 to do your next property.
Okay. So you actually sell these properties? Like you're the developer in these markets.
Correct.
Okay, and you're in multiple markets.
Correct.
Okay. And so I come to you and I buy the property. Can I get in that model, would I be, well, it's turnkey, it's already done. I can get a mortgage, right?
Absolutely.
So the standard person that buys a turnkey property would what? An investor would put 20%?
Generally put 20% down on a single family, 25% down on a 2 to 4 unit multi-unit, conventional mortgage if they qualify.
Okay. And I just want to, put a cap on it here. So I would be buying it finished, but I can identify it before you renovate it. So it's like making my own custom rental.
Pretty much, yeah.
Okay. So but I'm going to buy it when it's done. I had it inspected by a third-party inspector. I had it appraised because I got to get a loan. I got a bank loan. There's a tenant already in, and I have a property manager. So what do I got to do after that?
Very little.
Okay.
That's why they call it passive long-term buy and hold.
Okay. So is this common? I don't think, nobody advertises, hey, I got a rental property for you. Do you advertise, on TikTok, hey, if you want a rental property for, actually, yeah, do you want a rental property for $200,000? Come to my, it's like a car dealership, come to my turnkey rental shop.
It's not exactly how we market ourselves, but no, I mean, we work with and provide our properties and our expertise to a lot of real estate investment associations in various parts of the country. And there are some educational groups that we also work with and provide the turnkey rental experts, if you will. And a lot of it also is repeat business. I'd say possibly as much as 85% of our sales are to people that we've sold to before.
That's tremendous. Okay. So, so we will put Phil's contact info in the links below because apparently, you're not advertising on billboards on, I-95. Okay. So it just, I don't want to really quick. What are the price ranges of these turnkey properties?
Generally, for turnkeys, they'll be broad range between 100 and 150,000.
That's significantly, I can get a kitchen in California for 100, I think.
Basically a bathroom.
A bathroom?
A bathroom.
Really? Okay. All right. So I think I'm clear on the turnkey. I think I'm clear on why you would do it out of these states that are expensive. So you're also an expert on something that, is near and dear to my heart, which is the BRRRR model. So can you explain what BRRRR stands for and why it's advantageous to use this method.
Sure. First of all, BRRRR, it's B and 4 R's, B-R-R-R-R. It stands for buy, rent. No, sorry. There.
I always get it. I wanted to see if you could do it without, messing it up.
Renovate, rent, refinance, and repeat.
Perfect.
Lately I've taken to describing this for investors. It's like buying a rental property and getting the wholesale discount. Meaning that, with the turnkey model, when I sell it to somebody, renovated and all that kind of thing, it's at market value. It is at market value. No built-in equity. However...
All right, hold on. It's at market value. So I guess the advantage in a turnkey is that I don't have to do anything really. It truly is passive, but you're not giving me like a discount, and we all love discounts.
Right.
Right.
But with the BRRRR, the way this works is you can do it.
Hold on. I'm going to smoke a cigar. I was really trying not to smoke the cigar, but this is what I do this time of day anyway, and it's like it's a habit type of thing. You don't mind, do you?
No, go ahead.
Okay.
Go ahead.
Right, so I'm smoking my cigar.
No, but with the BRRRR model, you buy a property that we have selected, for example, but we've been very careful to select it, and this is an element of why you want to work with a knowledgeable team. We have picked a property that we know not only what its value is today, but also what its value once renovated is going to be. We also use our crews.
Hold on. So how can you know what the value of the property is going to be?
Well, what do appraisers do? Appraisers look at closed sales comps, generally within a quarter mile of the subject property that have sold within the past 6 months. We do the same thing. So we know if that property has been renovated, we can comp it or compare it, because comps stands for comparables, compare it to other properties that have sold similar size within a quarter of a mile within the last 6 months. And so what we look to do is we have our general contractor go through the properties, make up what's called a scope of work to renovate that to what we call a rental standard. We're not, spending money unnecessarily. We're not putting in typically granite countertops and stainless steel appliances, but very highly functional, fully renovated. This is not merely a lipstick on a pig, as I call it, type of renovation. This is a full renovation. And it would be like buying the property for, say, $60,000. Maybe the renovation costs $40,000. So you've got $100,000 invested, but we know in advance that property is going to be worth $130,000 after it's done, after it's renovated.
Okay. Hold on a second. So first off, you can buy property for $60,000?
You can.
Okay.
We can.
Okay. Now, if that number was 60,000 plus 40,000, you're in for 100, and it's worth 130, right? So you charge me 130 and you make 30,000?
Not at all. Not at all. Our profit actually is built into that purchase price of the property, the 60 or whatever it happens to be.
Wait, so I walk in, I got 30,000 in equity.
You walk in after it's renovated.
In that example.
You paid for it, and you have 30,000 in equity. So really the question is, how do I get that equity out?
Oh, you're a step ahead. Okay. I keep getting this thought, and I'm going to throw my guy Sam off a little bit. Sam, Phil and I we have many, many years in the real estate game. So we may be saying terms that are not common to people. So I don't know if you got something to write with, but later at the end of this, I want you to be like, hey, I don't know what that meant, or what did that mean? Because I think it would be helpful for the viewers. And I apologize if we're having like an esoteric conversation. So I'm gonna try to come back and dumb this down. So okay, buy a property for 60, put 40,000 in it. It's worth 130. Before you get into like how do I get it out? How would I even do that? Can I get what if I don't have $100,000?
Good question. Then most often what somebody would do, unlike some bombastic people in this industry, I won't bother to name, I don't believe that you can buy real estate with no money. You know, that's a fantasy in my opinion. But if you've got 30 or 40,000 in cash, and there are a number of ways you can come up with that cash, not just in a savings account. You can maybe pull equity out of your own home if you have any equity in there using something called a home equity line of credit or HELOC. Maybe you have a 401k that you can borrow against. You never want to break it because that's unnecessary to get the penalty for doing that. And you don't necessarily want to do a self-directed because then there are a lot of restrictions on a self-directed retirement account. So you can borrow against it because who are you paying back? A bank? No, you're paying yourself. So that's another good source of, generally you can pull 50 to 80% of your retirement account out in cash. Anyway, so whatever cash you have, 30, 40,000, or more, you can get what's called a hard money loan. And it is what it might sound like to some people. High interest, currently around 11%. And short term, it's usually a 1-year deal or note. But there's no prepayment penalty. But here's the
Okay.
rub.
You said it. What's a prepayment penalty?
Oh, okay. Prepayment penalty with some loans are that if you pay them off early, you get penalized. It costs money.
Okay. So let me just tell you this because, even in 30-year mortgages now, I see this all the time. They have 5 or 3-year prepayment penalties. And it usually, like on a 5-year one, it'll go 5, 4, 3, 2, 1. That means if you borrow $100,000 this year and rates drop and you go, I'm going to refinance, you have to pay a penalty of 5% of that loan. So, I don't want to get into something crazy here, but you have to really analyze, is it better to pay a higher rate with no prepayment penalties? Because then you have the option of refinancing when you think that the rates will go down, or is it better to just take the rate and say, hey, I'm going to keep this for 5 or 3 or however many years? But sorry, you said something. I want to define it. So
I know, I appreciate that. And frankly, side note here, we counsel and hold the hand of the investor every step of the way. We are not lenders. We don't give financial advice, accounting advice, legal advice, but we have enough insight into the financing of property to be able to direct them beneficially. And so they might get a hard money loan. Like I said, the hallmarks of which are 1-year term, no prepayment penalty, high interest, sometimes higher fees. You could have what are called points. Each point represents 1% of the loan amount. But it's a great way of getting short-term money. The point is that you're not likely to have that loan more than 6 months. And the way that works is this. Let's take a step back and say you bought that property 60 and 40, all cash. Okay? Fannie Mae, Freddie Mac, they control all the rules for conventional lending. And they have said, if you have paid cash and you wait 6 months, they call it a seasoning period, you can then pull out up to 75% of the appraised value of that property. Here's the special sauce. Without regard to what you paid for it. Meaning, if you paid $100 total
60
and
plus
it's
40.
worth $130, you go and after 6 months and you get 75% of that, which happens to be $97,500.
Okay. This is
when
an
you
example
only
used
paid
all the time.
100.
Yeah. Okay.
So here you've got, imagine this. Here you've got now a property fully worth $130,000. And you've just pulled out $97,500 to turn around and use towards your next property. And we actually, on your behalf, stack the dice a little bit because we have picked properties that you can do that for, and they're still going to cash flow positive. So
I was going to ask that. So,
you end up with a property that's cash flowing positive. You've got enough cash to go do battle with your next property. So you're, in essence, recycling your funds over and over and over again and accumulating 2 properties per year at that rate.
Okay. So all right, that's the Burr method.
Correct.
Really. So, but in the Burr method, I have to buy a dilapidated house. I have to manage a contractor.
If you do it yourself, yes.
Okay. So, yeah. So I have to buy it. I have to manage the contractor. I got to find a tenant, find a property manager, have all these things that I don't have to do in the turnkey, I have to do, which people are going to hear, either scary or risky or yada, yada, yada. So when somebody does a Burr with you, what are they getting? Like, why can't I just go get a Burr from anybody?
Sure.
Or just do it myself?
In fact, I coined a phrase some years ago. I call what we do a Burr key. It's a combination of turnkey.
That's good, man.
And using the Burr strategy.
Okay.
See, Burr is not an alternative to turnkey. It's an accelerator. It's like doing a turnkey on steroids. And you get to take advantage, as I said earlier, of the wholesale advantage. And so what they get when they work with a company like mine, we're not the only show in town, mind you, but we have picked the property that we know is going to have a much higher, here's another acronym for you, ARV, which stands for after repair value.
Okay.
And we also know that what the renovation cost is going to be. And so...
if I had to do that myself, I would have to get multiple contractors, and I would be like,
And can you trust them? I don't know. I've had the same general contractor for over 10 years. I kind of trust the guy.
Right.
And so you don't have to worry about finding the right property. We've taken care of that. You don't have to worry about a general contractor you can trust. We've taken care of that. And in fact, our contractor always brings it in on budget, on time. So you don't have to worry about that awful phone call. I've heard horror stories over the years where you'll think you're within weeks of finishing, and you get that dreaded phone call saying, oh, gee, I just found something I hadn't known about. I need another $20,000.
Okay. So you said something that, people are going to be like, there's no possible way. So how can you say that your contractor always brings it in for the right price on time?
Because I have him go to every single property before we offer it and draw up, as I said earlier, that scope of work. Again, we like our acronyms. We call it an SOW.
Okay.
And he details out everything that has to be done and the costs. And he has to stick to that.
Okay. All right. So with the Burr key, which I like that Burr key, I'm picturing a little grid here, turnkey, Burr key, right? First off, is there something else that we should elaborate? Is there another strategy that your company helps people with besides turnkey or Burr key?
Well, I mean, we can do what a lot of people think is very cool, fix and flips.
Okay.
But basically, a fix and flip and a Burr are the exact same thing. The only thing that differs is the disposition at the end. In other words, with a fix and flip, you find the property, you renovate it, and you resell it, and that's how you get your profit out of the deal. With a Burr, you get the property, renovate it, and instead of selling it to get your profit out, you go to the bank after a seasoning period and you refi cash out to realize that built-in equity.
Okay. So, well, I just feel like I'm at the interest rates in my head. So, how can you flip a property with interest rates like today? How can you find a rental property that cash flows with interest rates like today? Like, what's your answer to that?
Well, I frankly don't even worry about interest rates. I don't even worry about inflation because that actually works for you. What I mean is, if you go and buy stocks or bonds, you've got maximum 2 ways to make money. The stock will go up or it'll go down. And maybe if it's a blue chip stock, you'll have a dividend. That's it. It's as good as it's ever going to get, period. With real estate, you've got 5 ways to make money. And I am getting to your question at the end of this.
That's good.
The first way is the one we talk about all the time, net positive cash flow. The second sounds like it's the same.
So let me ask you a question. Would you ever buy a property that doesn't cash flow?
No. Absolutely not.
That's my number one cardinal rule.
Absolutely not.
Okay, go ahead.
Number 2, equity growth. A lot of people think it's the same thing as positive cash flow. It's not. The tenant pays the rent pays the mortgage. Every month that the mortgage is paid, your equity ownership grows in that property. Now, the third one is interesting.
So basically, they're paying down the mortgage for you.
Correct.
Okay.
Correct. And thereby, your equity ownership in that property grows. Third profit center of rental real estate is appreciation. Now, it's not the reason you should ever buy a property. That's what a lot of people in California made the mistake of, because investors don't chase appreciation. Only speculators do.
Yeah, I mean, listen, I can tell you that before 2008, I would buy stuff that didn't cash flow because it was going up, and that works good until it stops going up, and now you got something that's negative, and you got to get rid of it. So, this is one of my biggest, hardest lessons that I had to learn. That's why I only buy stuff that cash flows. So appreciation's like gravy,
Well, like I often say, if you buy in an investor-advantaged market anywhere, you have a reasonable expectation to enjoy some appreciation. It's not the reason you bought it, but it's the third profit center. Fourth is really easy. Everybody agrees, is tax benefits. They differ from person to person, but everybody enjoys them. The fifth, though, speaking to your question about, what happens when interest rates go up? Inflation generally follows, doesn't it? Why should you not really worry about that? The fifth profit center is a cool one. It's called an inflation hedge. The way it works is this. When you go and get a loan from a bank, you're borrowing today dollars to buy that property. But what does inflation do to the value of money over time? It lessens the value, doesn't it?
Yeah. Like 100,000 today is, well, let's
with
go
10%
back.
inflation, if you borrowed 100,000 today, next year, or had 100,000 today, next year it'll only be worth 90,000.
Okay, people have a hard time with this. So let me just bring it back. It's very easy to do this. If you had $100,000 saved to buy a house in 2020 before the pandemic, and then after the pandemic, you had that same $100,000, the houses went way up in value. So you're like, oh my God, now I can't afford anything. But the houses didn't go up in value. The value of the money went down.
Exactly.
Okay.
So the way I characterize it is you're borrowing today dollars, and over time, because your payment stays the same, you're paying back with lesser value tomorrow dollars. And the coolest part about this is the bank is never going to come after you to make up that difference.
This is the only time I think we get one up on the bank.
Exactly.
Yeah.
Exactly.
That's
so,
great.
Honestly, interest rate, not a big deal. The question I often get is, when's a good time to buy? Is now a good time the best time to buy is today, and better than today, yesterday.
I heard a couple ones, which is true. The best time to buy a house was 5 years ago, always, right? And, I love this expression. which is, you marry the house and you date the rate. So, don't get so caught up in the rate because, if you're getting a good price today and rates go down, you can always date the rate and change the rate, right? But a lot of people are on the sidelines right now and they're waiting for rates to go down. And what's going to happen is rates are going to go down, but the prices are going to go up. So what did you wait for? You're going to end up at the same place. If you want to guarantee you get X dollars, a good investment, you should buy now and then refinance. Because I think in this moment in time, most people believe, well, they even said that the rates are going to come down later this year. And if rates come down, prices are going to go up. So, all right. So now let me go back to the grid, and I'm going to let's try to put a button on this in the next 5 minutes, and then we'll talk about some fun stuff. So the grid is turnkey, Turnkey, which I never heard before, which is great, and fix and flips. Now, I'm afraid to ask you if you do something else, like if you have a dance routine or something, because, and we don't have time for a fourth. So let's stick with those three.
Okay.
All right. So give me, if you're counseling me, give me a pro and con, like why would I want to do a turnkey as opposed to a burr, as opposed to a fix and flip? Like, how do you decide what's good for somebody?
Well, first of all, I typically ask 3 questions, which sets the tone and direction and how quickly they can get where they want to be. The first is, how big is their war chest? What are they dealing with in terms of liquid capital ready to deploy when they're ready to pull the trigger? Okay? Could be cash in the bank. Like I said before, it could be borrowing against your 401k or taking a HELOC, home equity line of credit, equity out of your home. That is a big one. Okay?
The HELOC.
Then the war chest is knowing how much capital they have to start with. That's going to determine a number of different things on direction. Secondly, what's your goal? Everybody, look, we've been doing this for 20 plus years. We know a couple of things about investors. Everybody gets into it because they have a goal. It might be different from everybody else. And I'm not asking people to tell me necessarily, is it you want your partner to give up the 9-to-5, or you want to give up the 9-to-5 job, or you want to buy a weekend place at Tahoe, or you want to buy an airplane or a nice watch or whatever. I'm asking you to express your goal in terms of thousands of dollars per month of passive income. As I said before, the only way to create wealth, and everybody agrees, from Robert Kiyosaki, Rich Dad, Poor Dad, even to Grant Cardone, passive income is the real estate doctor even says this, that passive income is the only true pathway. But what are you looking to achieve in terms of your goal? $3,000 a month, $6,000 a month, $9,000? The reason I picked multiples of 3 is because in investor advantage markets, turnkey properties typically, if done classically, are going to spit off, give or take, about $300 a month. So let's say your goal is $6,000 a month. Divide it by 300. I'll do the math for you. It's 20 houses, which I think to the average person, 20 houses, oh my gosh,
sounds like
that's
a lot.
Crazy.
Yep.
But let's say the third question there is the time frame. How long are you giving yourself to do this? 5 years, 10 years, 15 years? Well, let's say it's 10 years. Well, 20 houses in 10 years is not that hard to do. Why? Well, we might put you, if that's where you want to be, into the BRRRR model, because you're recycling your cash. You just basically got to get in on that first one. 6 months later, you're going to cash out, refi. Even if you've used a hard money loan, you'll take the cash out and you'll pay off the hard money loan. You'll sit back, you'll find your next property and do it again with hard money loan. And each time you do it, you're going to accumulate more capital. But so it's not that hard to do. But here's the biggest difference between fix and flip and either turnkey or the BRRRR strategy. Fix and flip money that you'll make, and you can make money with fix and flips. It takes as much capital to do a fix and flip as it does a BRRRR. But when you're done, instead of having that cash in hand like you can with a fix and flip, you pull it out in a refinance and you reinvest it. A fix and flip, you've got the cash in hand, and that's pretty cool to have thousands of dollars sitting in your hand.
I would say so.
But it's one and done.
Oh.
It's one and done. You haven't built anything. You've made some money, which is cool, but you haven't built anything. It's not creating wealth. So, if somebody wants to merely make cash, make money, not concerned with the future, not concerned with creating wealth, building a portfolio, and so on, maybe a fix and flip or a few fix and flips to get their cash position up makes sense.
Okay.
If somebody is remarkably conservative and they can't wrap their head around the idea of the BRRRR strategy, where you're getting in, you're buying, you're not really actively renovating. That's our job, but you're getting in, you're renovating, and then you're refinancing. Even though we kind of hold your hand throughout the process, we'll introduce you to the lenders you need to work with, and get that done. Help you to get that done. Find your next property.
That's a high five. That means 50 minutes.
No, so if that is overwhelming to you, classic, what I call vanilla turnkey is for you. It's very conservative. It's very safe. You'll invest your money and you'll maybe enjoy a 10 to 12% cash on cash return and make $300 a month.
Yep.
But the returns that you are likely to enjoy, again, because you have added value to the property through your renovation of it with the BRRRR strategy, you can easily be looking at 20 or more percent. In fact, we don't make a big deal of this because we don't like to guarantee something we can't always deliver on, but occasionally we're able to find properties for our clients that offer what we call infinite returns, where if you bought that property for 60, you put 40,000 into it, and it happened to achieve a $135,000 appraisal 6 months out, 75% of that is $101,250.
You do these numbers all the time, huh?
Yeah, kind of.
Okay. All right. So I'm just going to ask you, just answer these questions.
Okay.
All right. If somebody is interested in stuff that you said, how much money should they have? Like, can I come with you? If I have no money, can I come talk to you?
You can always come talk to me. One thing that I never charge for is insight and advice, because the person who has interest today is possibly a great client tomorrow.
That is tremendous. I think you should take that up. Don't have 10,000 people call, Phil tomorrow. But I'll tell you, it's free advice. So, you don't even have to buy anything. Okay. But if I want to, I feel like I'm ready to do something, what's a good number to start with?
30 to 40,000. 30,000, it's a little challenging because it means we've got to buy a certain property and they're not always available. 40,000 is a lot easier to work with. 50,000 is almost over the top.
Okay. What's the most, if I came to you with $3 million, could you handle that?
Oh, I could handle that, but I wouldn't sell you $3 million worth of properties at all. And this is why. I would give you the same advice, and I have had people come
glad
to
I
me
asked this question
with $1 million or $2 million, and I give them the same advice as somebody who comes with 150,000. Let's pick one good property. And the reason behind that is I want them to learn, but I, more than anything, want to build a relationship with that person. Because relationships in this business are everything. And I want them to have the confidence in what we're doing and see that it works.
Well, okay. That's
But
spectacular.
could I handle $1 million, $2 million, $3 million when somebody has that trust and that confidence? Absolutely. We are blessed, not only because we work in multiple markets, but we have really excellent deal flow. A question I often get is, where do you find your properties? Well, We have our own in-house wholesale unit. We also have a small handful of trusted wholesalers that don't gouge us, that we can lean on to sometimes source properties. Foreclosures are also a good source. Short sales, when somebody's upside down, they owe the bank more than what the house is worth, and you work out a deal where the bank accepts less. That's a short sale. Or even a tax lien sale. But here's another advantage that we can bring to the table because we've been in business so long. And that is we have a lot of clients that are foreign nationals that bought 10, 15 years ago. And they bought all for cash because they were locked out of the mortgage markets. So maybe they're looking to cash out on properties. They've held it long enough. We can work out a price that makes sense for them, that even with a modest margin for us, works for us, and is attractive for an investor.
Okay. First off, that's a good question because I have a lot of international audience. Can people from other countries besides the United States invest with you?
Absolutely.
Okay. What you said them, I just want you to reiterate. What are the typical returns if I'm going to buy a BRRRR, if I'm going to buy a turnkey, what's the typical return I'm going to get?
Obviously, it's tied to the average cap rate in whatever market you're buying. But if you're buying in a decent investor advantage market where the cap rates are, 8%-ish, plus or minus, you're probably going to be looking at, and I'll use the term cash on cash return of 10 to 12%. What that is that's the annual return based on the actual cash out of pocket to buy that property. It's, in my opinion, more important than cap rate, which simply defined, cap rate is when you take the...
Let me do it real estate doctor way.
Okay.
So basically, if I have $10,000 I put in the stock market and it makes, 10%, that's what you're talking about. If you have $10,000 only in a deal and it makes 10%, 10 or 12, that's what you'll make. But you also own the property, have equity, and it can go up in value. So you have those other things too.
Correct.
Okay. BRRRR, what kind of cash on cash? BRRRR key. I love that.
Yeah.
All right.
Cash on cash very often typically is 20% plus. Okay. I don't like to if you go to places like Facebook and you look at some of these people that are talking about BRRRRs, in their definition, inexpertly, they say if you don't get 100% of your cash invested out when you do a refi, that's a fail. That's dead wrong. My line in the sand is, because I only will pick properties that you're likely to get 90% of your invested cash back out when you refi, that's cool. I don't advertise that I can get you 100% of your cash out, but occasionally we have properties where you can.
Okay. That's tremendous. Flipping, what kind of return could you expect to get?
Flipping, there's so many different factors which can impact on this. So I don't want to get lost in the weeds on that. But if it's a good flip prospect, and we do have good flip prospects, you can enjoy very often broad range 15 to 25% return on a transaction that'll take no more than 6 months.
15 to 25. So
annualized would be 30 to 50% return.
So I could say, find me a fix and flip. I got $100,000, and I could expect to make 25 to 50,000.
You could have 125 in 6 months' time, and then you do it again, and you'd have
a little bit over 150.
Yeah.
I was trying to do that math quick too. Okay, all right. I'm afraid to ask. Is there anything I should have asked you that I did not?
Wow. That's a loaded question.
Yeah.
How do you stay focused in such a beautiful environment?
Well, I'm usually back in that apartment, which is my office. I mean, man, it's a good question. I get up and I have a morning routine. And after I execute that morning routine, the line in the sand, I put my kids on the bus. The line in the sand for me is I take a shower. I I shave, I put on clothes like I'm going to an office. I mean, maybe not an office because I'm wearing shorts in this, but
It is
I,
Aruba after all.
yeah, I take a shower, and after that, my body knows it's work time. And I'm trying to define a new word. I'm trying to come up with an alternative word to work because it doesn't feel like work. I enjoy what I do, and I think too many of us are saying we're working when we're really enjoying something. But I haven't come up with that.
You and I have known, as you said, each other for over 10 years. And I've got to say, I've observed you under a many variety of circumstances. I'd say I don't know anyone who has a better work ethic than you do, even today.
Thank you for that.
Lord only knows how.
I receive that.
But also, too, you have been, this is maybe the Mutual Admiration Society, but you have been a mentor to me.
Wow.
And, one thing, it thrills me to no end that we still have a positive relationship and we can work together on various things, counsel one another. And it's an absolute thrill to be here and kick you out of your apartment well, for a few days or whatever.
I'll tell you what, Phil, really where he messed up. He took my wife's coffee cup.
Oh, gosh.
3 days in a row. My wife, it's not that one, because my wife today came out and said, listen, Phil, I'm sorry, but...
She was really nice about
it. She hid the cup from him today, and he found it.
Yeah, but the difference is she's 5'3", so she thought she hit it well. I'm 6'3". I saw it easily.
So that was a funny one. All right, well, thank you for those kind words. And I learn every day from many, many different people, but definitely from you. All right, so here's some fun questions.
Okay, hit me.
What's your favorite drink?
That has changed a lot over the years. There was a time when Tanqueray and tonic was it, and so much so that an English friend of mine used to refer to me as Lord Tanqueray. And every email he would address me as my lord. But no, I spent about 14 years in the wine business. And as such, I have to say I'm a wino through and through. I prefer red wines to white, although more and more these days, as I'm eating more and more fish and chicken and things like that, I'm drinking more and more nice white Burgundies. I prefer California Cabernets, seconded by, maybe red Bordeaux's. And thirdly would be something called, I won't bother to describe it, but Appassimento-style wines, red wines from Italy. But wine is definitely my favorite drink.
So he is definitely a wine guy. And I am not a wine guy. I don't drink wine at all. I've really attempted to it. So he's had to deal with the gifts that people come to my house with that I don't drink.
But I have no competition for him either.
Yeah. All right. So actually, because you said that, here's another question I should ask everybody. Do you speak any other languages?
Let's say I have a pretty good working knowledge and handle on French. I'm not fluent, but I have lived in France, and my partner is half French, and she has lived in France, and we're even toying with the idea of moving to France.
Yeah,
but
I know you will.
Yeah,
that's 100%. I can't wait to.
A question that I've often been asked, though, and perhaps you have too, is, what are we going to do, Phil, when you retire? So, I mean, my answer is the same. Retire from what? Yeah. The old adage is so true. If you do what you love, you'll never work a day in your life.
That's amazing. I agree with that. But I can't wait to visit you in France. And he definitely cooks well, too. So, next question. What's your favorite thing about Aruba?
Well, it's funny. Yesterday there was this massive, rain shower, which is so rare. And I've been to Aruba over the years many, many times. And I know it rains infrequently, but occasionally. But I was like a little kid standing just inside the glass, staying dry, but looking out at this downpour, deluge. It was really cool. But what I really appreciate most about the island, it really
People
is
living in London or Seattle are going, "You're amazing, Rain. Come see me."
Oh, yeah. I mean, the thing is, in England every day, it's like, oh, it's another great day in paradise. Um,
And Phil lives half a year in England, so that's
it is true, but no, I mean, the saying, the tagline for Aruba is "One Happy Island." I think that what I appreciate and enjoy most about this island is the people are amazing, the beaches are just perfect, um, great restaurants. Nice trade winds if you like to wind suffering. I mean, surfing.
suffering.
For me,
Definitely,
it's wind suffering.
when the wind is not here, I am suffering.
But no, it's just a really beautiful. It's outside the hurricane belt, so the weather is just amazing.
I think you can work for the tourism board here.
Well, in point of fact, a long time ago in a previous life, I used to publish destination guides for the Caribbean and Mexico. So, yeah, I kind of came to know a lot about it.
All right. Last question. In 2024, what's the most important or biggest thing that you want to do, personal or business?
Wow. Can I give a couple of things?
Sure, man.
In June, my oldest or second daughter is getting married. My younger daughter got married last year. That's a big event. Very excited about that. And I'd say I would like to grow within the United States, especially our client base, because we're developing this model in California that I think is sustainable for elsewhere. So business-wise, I'd like to grow the business from that perspective. And other than that, I want to enjoy the travel I'm blessed to be able to do, and to continue listening to and following the advice of the real estate doctor.
All right, you're too kind. Okay, so before we end it, Sam, I don't know if you have any stuff. So, Phil, thank you for being on the podcast. I really appreciate it. I'm sure people have really gotten a lot of value. And thank you guys for watching the Real Estate Doctor podcast. Have the best day of your life.